Hello, everyone, and welcome to another great episode of the Jason Howell Company Speaker Series. My name is Jason Howell, and of course, we've got a great episode for you today. We have a Mr. Ron Gutstein of CO2 Advisors, president of CO2 Advisors, and we're going to talk a little bit today about how to invest in carbon credits through the public markets, which is very distinct. Every piece of that is actually very important and typically difficult to do, especially in the United States. But we're going to talk to Ron about that, what's changed, what opportunities there are, and perhaps a whole bunch of other things. But before we pummel him with a bunch of questions, let's just welcome Ron to our event today. Ron, welcome to the Zoominar. How has your day been so far?
Hi, Jason. Thanks very much for having me. I appreciate the opportunity to have this conversation. Day's been pretty good so far. My son went back to Ireland yesterday after being home for 2 weeks, so it's
Wow.
a little bit of a readjustment.
Oh,
And
good
getting back
readjustment,
into,
bittersweet.
of course, all of these things. It's an incredible experience. 23 years old, from a baby to grown man on his own. So it's exciting. Nice to have him back for a little while, though.
So when are you going to get back to Ireland?
We actually were over in November for he finished his coursework at Trinity Dublin in May, and they
Okay.
actually hold a graduation in November. But he's now working full time for a company in Dublin, so we went over to meet him for graduation. We spent almost all of Thanksgiving over there, so probably back in March or April we'll head back again.
Not too
It's a
bad.
short trip, so it's a pleasure.
Oh, not too
I'm
bad
sorry.
at all.
Yeah,
You,
we'll take it. Very
you
nice. And your
consider
day?
Ireland a short trip. I'm going to feel bad for my domestic trip that I had just over the holidays.
Ah,
Well, thanks so much for being here, Ron. I'm looking forward to this conversation. I know that anyone who's clicked in here has probably going to be looking forward to it too. So thanks again.
thank
And what
you.
I'll do here is I'll share my screen for folks with this small display so that people can follow along a little bit. But if you clicked on this video and you're interested in how to invest in carbon credits through the public markets, you came to the right Zoominar. Ron Gutstein is the guy for it. I had a great conversation with him just before the holidays a few weeks ago, and I thought, my gosh, we've got to get here, record this, and share this with a bunch of folks. So before we get to the Q&A, let's just have a word from our sponsor. And our sponsor, of course, is the Jason Howell Company. Jason Howell Company is the family wealth advisory firm. We're located in Fairfax, Virginia, but we serve clients all throughout the country. And what we do is partner with a number of experts so that we can bring all financial content and expertise to all family members all of the time. You hear the word holistic a lot. We certainly do that. We position ourselves as something of a family office, working with these experts like Ron, for example. And by doing this, we can surround our clients with a team of people who are there, again, to support the family for life after wealth. For more about our firm, you can go to jasonhowell.com. But for now, let's just talk with Ron for a bit and learn a little bit about him. Ron, thank you for this bio. I love how comprehensive it is. And one of the things I wanted to do, and we spoke about this a little bit before, is just poke around at some of the words and phrases that even people in the finance industry, they should know, but they kind of don't know. So tell us a little bit about being on the buy side and the sell side when it comes to investments.
Absolutely. Thank you. Very simply put, it's a matter of where the assets and where the services are being provided. So the buy side is largely considered the asset managers and the fund managers, the ones that are making the investment decisions. Whereas on the sell side, you're looking at people that are like the traders, research analysts, investment bankers. Those are the people that are servicing the asset owners. So in my experience, I worked on the buy side when I was a trustee of a mutual fund, and our responsibility then was overseeing the investment of, at one point, over $20 billion through two funds. And on the sell side, I worked primarily as a market maker, where I was trading about 150 stocks, making markets actively in them, and also servicing institutions in trying to help them execute their purchase and sells of the various equities across many asset classes.
All right, thank you for that. So we got a definition on the buy side and sell side. You threw another one in there, a market maker, which is really neat. And as I try to describe that phrase, and I'll be happy to have your further definition. It's really what makes us able to trade our stocks and ETFs within a second, right? The fact that there are middlemen essentially there to trade those stocks for us, regardless of the fact whether Bob in Kansas wants to sell his Nvidia or Microsoft stock. I can always get a sell for that or a buy for that because of these market makers in between. Have I described it pretty well?
Perfectly. It's our job is to facilitate buyers and sellers meeting, and if there is a lack of liquidity on one side, we step in and provide that liquidity in order to facilitate a transaction.
No, it's great. Now, you've also been a trustee of a mutual fund. Tell us about that kind of job.
Sure. Mutual funds are organized under the 1940 Act, Securities Act, which means that they are registered investment companies with boards of trustees whose job it is to oversee the investor, the company that's making the investment decisions, and make sure that they are following the prospectus that they laid out, and that policies are being followed, and that the investors' interests are being looked after.
Great. Yeah, the Investment Advisor Act of 1940. I know it well. I love that act. It's certainly what separates the fiduciaries from the non-fiduciaries when it comes to our business, the brokerage houses versus the advisors. So neat that you have that experience directly. Now, you've also done some work here as an activist or being part of an activist campaign when it comes to carbon, which is part of our conversation today. Tell us a little bit about that.
Sure. As my role as a market maker and a sales trader for several of my institutional clients, had established a large position in a very small timber company that was in the Upper Peninsula of Michigan. A long-standing shareholder owned a large portion of the company and really ran the management and the board. We kind of decided that the management and the board wasn't really looking after the shareholders that weren't the family members. And so we ran some proxy contests to try to force a change. And I ended up successfully bringing in another large investor who ended up winning a proxy contest, and they were able to help realize some of the value for the company. And one of the things that we ran on, it's a timber company, was to try to do carbon projects and increase revenue by doing voluntary carbon markets.
Voluntary carbon markets. That's fantastic. And so then over the past few years, you've been working on this project, now this LLC, CO2 Advisors.
Exactly. We formed CO2 Advisors LLC to be the sponsor of the CO2 Advisors Physical European Carbon Allowance Trust, which is the actual ETP. So there's the trust that owns and the EUAs and issues the shares, the EUAs being European Union allowances, which are the actual carbon credits. And then CO2 Advisors is the sponsor, which means we run the day-to-day operations and make sure that the trust is running properly, and that the ETP is, the shares are being issued, and that we try to help grow the investment.
Awesome. Well, the first time we spoke, we talked about how most of the conversations you have are really educational, that you've got to walk people through an educational baseline. And I feel like we're doing that here, which is a good thing, which is a really good thing. And we're going to continue that here in the Q&A a little bit because some of the terminology, some of the vocabulary is really important for people to understand the true benefit of what you're sharing that can be done now in the United States through almost exclusively your firm, but perhaps in other ways in the future too. So let's do that. Let's get really basic or continue being so, and let's answer that first question, Ron. What exactly are carbon credits?
Fantastic. Essentially, you have to think of a carbon credit. It's pretty analogous to a water rights. It allows an emitter, a covered industry, to release 1 metric ton of greenhouse gas equivalents, which is generally carbon dioxide. And it's important to make a distinction between the mandatory market and the voluntary market. On the mandatory market, we use terminology such as carbon allowances or carbon credits. And on the voluntary side, we talk about carbon offsets. So you have to think about, one is, for every ton of emissions I have to turn in a carbon allowance or a credit in the mandatory market. And on the voluntary side, people decide how much of their emissions they want to try to offset by buying pieces of projects that are done that try to reduce carbon dioxide in the atmosphere. We have opted to facilitate investments on the mandatory side for a variety of reasons. Primarily, it's a regulated market, whereas a voluntary market isn't. There are secondary markets where provide liquidity, which the voluntary market really is limited liquidity on the secondary market. And on the voluntary side, you really are required to do ongoing due diligence to make sure that the project accomplishes the goals that they've set out to do. Because if they fall short, the carbon offset you bought actually didn't do anything and there's nothing backing it. Whereas if you own an allowance or a credit that's issued by a government entity, you know what you have. And if I buy an EUA in Italy, it's good for emissions that I have in the Netherlands. So it's fungibility between the markets. And it's also important to note that on the mandatory side, it's a cap and trade system. So they've capped the amount of emissions that can be released in the entire area, and then they've issued allowances against that cap. And the entire idea is that over time they reduce the cap so that fewer allowances are issued, so that the value of the allowances that are issued goes up. And again, it comes back to changing the economics behind emissions. In the old days, society bore the cost of companies' pollution. In the U.S., think about Love Canal. Some company polluted and destroyed an area, and the government had to come in and clean it up, which means the taxpayers paid the bill. In the EU now, with the mandatory allowances, the price of emissions is built into the corporate cost structure. So they are paying the cost of that emissions by having to turn in an allowance for every metric ton. So they now have an economic incentive to reduce their emissions, because if they reduce their emissions, they need to buy fewer allowances.
Wow, there's so much there, mandatory versus voluntary, but I have to underscore and separate this phrase that you're using, which is our second question around European Union allowance. Can you describe, and I think you effectively have, but what that distinction is in Europe, sanctioned by the government in the EU, versus what we have here in the United States?
Sure. In Europe, there is a mandatory market, which means there are about 12,000 installations that are obligated by law to turn in allowances for every metric ton of emissions that they release into the atmosphere. And that the only way they can do that is to have to buy EUAs in order to cover that requirement. In the U.S., other than small areas such as California has a mandatory market, but it's much smaller in terms of what it covers. The Northeast Regional Gas Exchange, again, it's a small subset of companies that are covered. So in the U.S., it's a hodgepodge of regulations, and it's done state by state or by region, and it doesn't really cover large areas of the economy. There is also on the voluntary side, which some companies do to, frankly, it's for public relation reasons at this point, where they say we buy offsets to lower our overall net emissions. And that's probably a discussion for another time and getting to some of the specifics. But and again, the other thing that we mentioned earlier, in Europe, if I buy an EUA that was issued in Italy, I can turn that in for emissions in the Netherlands or Ireland. If I buy a allowance or a credit on the regional gas exchange, that can't be used for the California mandatory market. So there's no fungibility outside of the requirements within the US. Whereas in Europe, any EUA issued in Europe is good for any emission done in Europe.
And so you have liquidity in the European market versus what you have in the United States, which I believe, let me get the detail right, I believe that's the hodgepodge voluntary market. You don't have as much liquidity. There isn't as much, almost any regulation.
Yeah,
So it's a different way of being, isn't it?
and it's interesting to, in terms of actual numbers. The London Stock Exchange, which owns a research group that used to be known as Refinitiv, released their market review for 2024 back in March of 25. So the new one should be coming out shortly, reviewing the mandatory markets around the world. They showed about $900 billion worth of activity in mandatory carbon markets in 2024. Roughly 800 billion of that was EUA trading, European Union allowance trading. So something like 85% of the market worldwide in mandatory carbon trading is done with the European Union allowances. So California only makes up about 5 or 6% of that, and the rest of the world makes up, the remaining 10%. So it's really the liquidity and the depth of market and the acceptance throughout the continent is really well established in Europe.
Yeah, the European Union allowances, that's kind of where it's at, that market. Well, as we're talking about investing in something like this, it would also be helpful if we explain this next question I have up here, the difference between what you're referring to, which is an exchange-traded product, versus something that's more common to most every advisor, most every client of an advisor, an exchange-traded fund. What is that difference?
My lawyer may not be happy with the answer I'm going to give you, but it's really semantics.
Okay. Caveat to the lawyer that
exactly.
Quasi.
I apologize in advance.
Okay. Yeah.
And I can certainly go into what it is. Yeah. All ETFs are ETPs. Not all ETPs are ETFs. And it comes back to a little bit about what we discussed earlier with the 1933 Act versus the 1940 Act. The 1940 Act for investment becoming an ETF, a fund, requires a registered investment company. The registered investment company is then managed by a registered investment advisor. The registered investment company has a board of trustees that oversees everything. And in order to qualify as a registered investment company, there are several tests that must be passed in order to get the IRS tax treatment for the pass-through entity. The one of the tests is 90% of the income has to be, they call it good income. And unfortunately, for better or for worse, European Union allowances are classified as a commodity. Commodity income is never good income. So we would never pass that test because that's our only asset. So we would never be able to have 90% of our income not being from a commodity. So we could never be a 40 Act company. So what we do is we set ourselves up as a 33 Act company. And that within that structure, the European Union allowances are owned by a grantor trust. The grantor trust is the pass-through tax entity. So we get the same tax treatment that a 40 Act fund, a 40 Act ETF would get through this structure. And it also streamlines things a little bit because we have a trustee for the grantor trust, which then has delegated the authority to make decisions to the sponsor, which is CO2 advisors. So it's really semantics. We get to the same place. We are effectively a pooled asset, which issues shares, and your shares represent fractional ownership of the underlying asset, which is quite similar to the 40 Act ETFs. However, FINRA and the SEC have decided that if we call a 33 Act product an ETF, they're concerned that investors might be confused that there is a registered investment company and a board of trustees overlooking the registered investment company, which we don't have. So they've asked us to, the guidance they have issued is to call it an exchange traded product rather than a fund.
And who is taking responsibility? Is that you as president of this product that is kind of overseeing things?
The sponsor has authority and responsibility over ensuring that everything is being done properly. And obviously, we are audited by a PBOC accounting firm. We issue 10Qs and 10Ks like any other listed company, which again is different than what an ETF would do as a 40 Act company. So we have the same reporting requirements as IBM.
Okay.
And the same obligations, and obviously the same kinds of processes and procedures in place to make sure that everything is that the prospectus is being followed.
So, from an investor point of view, if they were to invest in an exchange traded product like yours, they're going to see similarly, their product alongside perhaps their funds with a market value assigned to it and be able to statement by statement kind of see how it's doing?
Absolutely. We publish an NAV every day. We are traded on the New York Stock Exchange every day. So there's a publicly available market that takes place. Literally, the only difference is the way that the structure behind the scenes takes place. It's transparent to an investor. They're not going to know the difference. I mean, for just as a point of fact, GLD, which is probably one of the largest funds, larger ETPs around there, is an ETP. It's not an ETF. They are a commodity pool that only owns gold, and it's well in excess of 100 billion right now.
Yeah, gold's did pretty well last year. So for those who made a call on that, congratulations. Tell us, Ron, a little bit about the difference between investing in a fund like yours versus what one might do here otherwise in the United States. I remember we had a conversation about the delta between futures markets investing versus directly investing in these mandatory carbon credits. Can you color that in a little bit for us?
Sure, absolutely. I'd be happy to. There are two or three major differences. The first being when you invest in the futures market versus the physical, you don't actually own the underlying asset. You own the right to buy the underlying asset at some future date. And if you never exercise that right, you never own the underlying. So that means there is no sustainability or impact investing benefit. Right now, we own 19,700 European Union allowances. That's 19,700 metric tons of emissions that a company can't release right now. So we are actually impacting the ability of companies to release emissions. We also, because we reduce the supply, theoretically, that can increase the scarcity factor, which means it's more economical for companies to look to change what they're doing than continue and buy EUAs. So we theoretically help move the process along of incentivizing companies to change what they're doing to lower emissions. You lose that value if you buy futures because you never own and never reduce the current supply. That's number one. Number two, every year, since you're never going, if you stay with a futures product and you just keep your exposure that way, you have to what's called roll out your exposure because a futures contract eventually expires.
Yeah.
Expires. So when you get close to expiration, you would have to sell what you own and buy the next year out contract. That transaction becomes a taxable event. So whatever your return was for that period, you've now created a taxable event on that return, whether it's a gain or a loss. We expect it to be a gain. So you've cut your gain because you've created you have to pay tax on that. Not to mention, when you roll out, You have brokerage costs. You have to pay to sell. You have to pay to buy. And the third and most important reason why we think physical ownership is better than futures is futures decay, meaning you're paying a premium as long as markets are trading as they normally would and should and have historically. The futures product trades at a premium to the physical market, and that is because whoever is selling you that futures product is giving you an option to buy some date in the future. So there's an expense to that. And so they generally trade at the moment, it's about a 2.5–3% premium to the physical market. And over time, as the time between the futures contract purchase and the futures contract expiration, that premium will decay, meaning it will decline. So at expiration, the premium and the physical market would be the same. So you've lost that 2.5–3% premium that you paid when you bought it. And you have to do that every year. So every year you're giving up 2.5–3% return. And on top of that, you're paying tax on the event of the rollover.
Because of the requirement to kind of get in and out of it.
Exactly.
Thank you for the detail. This is so helpful. And I know so many people are going to be asking questions about the details. So hopefully we're covering preemptively what some of those questions would be. And I think the next question I have kind of came up from a previous conversation we had where, are you the only fund like this that's available, and why is that? And if that's the case, I believe that was the case, and then why hasn't this been available in the United States, which I think we've answered previously, but go ahead and share your thoughts.
Sure. We are the first and only fund in the U.S., product in the U.S.
That's right, product.
I said product. That owns physical European Union allowances. There are a few ETFs that own futures exposure. So we are the first to actually do the physical. It took us 2.5 years to get through the SEC in order to do that. And that probably is one of the major reasons why you haven't seen any other physical, because the requirements of registration for a physical product that hasn't been done before. So that was number one. Number two, it's education. You and I have discussed that a lot of the conversations we have with potential investors is explaining what an EUA is and and the value behind it. And that makes the distribution more difficult and more time consuming, which also gets into the third part, is it's a niche product. Not everybody is going to understand the various benefits away from the impact investing. You're buying a commodity with a limited supply, and at the moment the supply decreases every year, and the European Union is increasing the number of covered installations. So you have a commodity with decreasing supply and increasing demand, which is somewhere where I always like to be. And we'll discuss, I'm sure, a little bit later where you get the portfolio diversification and hedging benefits of owning another asset class. So although it's a little bit of a niche, part of that is the education to explain people why it should be part of almost any portfolio, regardless of your investment objectives.
Yeah, and as people try to put this in an allocation for their portfolios, most of the time when we're doing this for our clients, we're looking at risks, and we're balancing risks versus return, of course. So how would you measure the risk of this particular product alongside versus other typical public investments that people might make within their portfolios?
Absolutely. And now I'm going to say something to make my lawyer happy.
Oh,
please
good.
look at the prospectus for a full list of the risks associated. That having been said,
excellently,
well I will. The two biggest risks that always come up in conversation, and in my opinion are the two biggest risks, are some major scientific advance that they put some kind of a filter on the top of a smokestack that makes the emissions zero, which would dramatically upset the supply and demand dynamic. yes, it is
Which
a
would be
risk,
great for the world.
which would be great for the world. I mean, I hate to say it's a nice problem to have.
Right.
Um, that having been said, you have several answers to that. One, the low-hanging fruit in terms of scientific advances have already taken place, and any scientific advance requires research money. And in order for that research money to go into a scientific advance, the price of an EUA has to be much higher. So, because in order to justify researching and developing new paths, there has to be an economic benefit. And if the economic benefit is I don't have to pay so much for as many EUAs, that is how money is going to be funneled into the research. So the price of the EUA will always balance out with the cost of additional research. So I think it's a balanced system. So I don't think that is as big a risk as you might think at the stop. And obviously, the second is the regulatory aspect. Does the EU come out and dramatically change the rules to lower the value? The nice thing about what we are investing in, there is dramatic, widespread support among European citizens. They did a study last year, somewhere in the neighborhood of 75 to 80% of the population is in favor of the system as it stands now and as it's expected to progress. So there is a strong political base behind it. And not to be cynical, but they're expecting to, the expectation is the EU is going to raise in the neighborhood of 100 billion euro over the next several, each year through auctioning.
Right.
And that's revenue that would be very difficult to replace. I mean, the beautiful thing about the way the EU ETS system right now is set up is that the cost is so widely dispersed among the economy that you don't really know, consumers don't really feel the brunt in anything that they're doing day to day. So the government is able to raise 100 billion euro without really upsetting anyone. If they got rid of the system or dramatically reduced it, which would impact prices, they're going to get a whole lot less money, and they're going to have to make up that revenue someplace else where they're likely going to have a lot of pushback. So I don't think that is as great a risk. And I'll conclude my defense of it by saying there is also a credibility factor. They have invested 25 years so far in developing the system. There are hundreds of billions of euros invested in systems in the EUAs themselves that were all driven based on the credibility of the EU government saying this is the policy we're going to pursue. So if they were to dramatically change the policy and hurt people that have invested vast sums of money, the next time they want to do something and say, hey, we're invest here because this is our policy, people are going to say, yeah, we've seen this story before. So just on their own credibility purposes for their future endeavors, they don't want to hurt people that have invested in this. So
yeah, that's kind of where you are, right?
Yeah, I think going forward, we're in pretty good shape.
Neat. Yeah, political risks, scientific breakthrough risks, but otherwise, talk to your advisor and ask for a prospectus for all risks listed here. Terrific. Thank you for sharing that. Again, it's one of those questions that people will have just on the surface, like what should I be looking at here? What should I be considering? I think you captured a good portion of what you would have on your prospectus, which is available on your website. Am I right? And your
Correct.
website, cotwooadvisors.com?
Perfect. Thank you. Yes.
Okay. Terrific. As we kind of finish up here, you're the perfect person to ask this next question, which is to ask, what is next in this space, Ron, as this is an advancement, thanks to, I guess, the regulatory framework provided by the European Union. Do you see other countries glomming on to this particular way of doing things, or do you see something else?
I think we're going to see an expansion of the system, not just in Europe, but worldwide. I mean, you see California, you see Northeast Regional Gas, you see Washington State. There are several other systems, Japan, Korea, they're all in the process of developing and deploying. China recently created a mandatory market. And so there's certainly a momentum building, and I would expect to see more mandatory markets developing regionally. And my expectation is over time, those regional markets will merge into a global market. And that will be where it'll be a true level playing field for everybody. And that's where I think we're heading. I don't think it's going to happen today or tomorrow or 5 years from now, but I would not be shocked if we woke up in 15 to 20 years and it was a global carbon market rather than just a regionalized one. It comes back to the simple point that, emissions released in the United States don't just stay over the United States. They go over Europe, they go over Canada, they go over Mexico. So
Right.
It's going to end up being, I believe, one of the global systems.
A global carbon market. Fascinating. And it's a moneymaker for governments, so that's not a bad thing when it comes to what we should expect. All right.
I was going to say, I'm a big believer in capitalist solutions to capitalism's problems. And this is, I think, one of the most creative examples of that I've seen in my career.
Well, Ron Gutstein, CEO of CO2advisors.com, if you'd like to find it, and one of the professor of some new phrases: exchange traded product, carbon credits, mandatory carbon, and then even some words that we do know as well: hodgepodge, semantics, and a few others. Thank you so much for spending some time and educating us on this topic. Much more to come, I think.
Thank you very much, Jason. I appreciate your time.
And with that, we yield the balance of your time.